Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. This is part of the 1M by 1M Global Virtual Accelerator. As you know, our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion in global GDP and 10 million jobs. And in support of that mission, we've been doing these free mentoring roundtables since the fall of 2008, so over 10 years. And this is the 436th episode of the free mentoring sessions. Of course, we have actually a lot more than that in the private sessions, which is for our members only. But this format of online roundtable mentoring, we have been using extensively and very successfully. Over 100,000 people have attended these roundtables, whether they've pitched or just participated. We've had a very, very extensive distribution of these roundtables. And the event is being recorded. Every single recording of our roundtables are available. The public ones are available on our YouTube channel, 1M1M Roundtables. So please go check that out. If you're looking for learning material, it's actually very good learning material. If you're live tweeting the show today, please use hashtag 1M1M. And you can join us on Twitter at 1M1M and at Romana, both channels. We publish a lot of interesting content through. These are the call-in instructions on your screen. 650-479-328 is the call-in number, and access code 409-929-990. We're not quite ready for call-in yet, but we will be. We will have plenty of time for Q&A and active participation from the audience. This is a roundtable, not a broadcast. We want you to participate as much as you would like to. We're going to start today with Sumant Mandal, Managing Director of March Capital Partners. Sumant, welcome to the show.
Thank you.
So, Sumant, let's start by having you introduce yourself a little bit, as well as March Capital and your other early-stage investment activities.
Sure. So I have been an investor in technology since the year 2000, so almost 2 decades now, and have invested broadly across the spectrum, very early-stage companies, have incubated more than 25 companies, all the way to pre-IPO companies, and have taken a few companies public as well, so sit on some public boards. March Capital was a fund I co-founded about 5 years ago. We have about $700 million under management. We have about 50 companies in the portfolio already in 5 years. I also co-founded 2 incubators in the Bay Area. One is called The Hive, with a gentleman that is a good friend of yours, T.M. Ravi. The other one is an incubator called The Fabric. The Hive focuses on artificial intelligence-driven companies, really enterprise software using artificial intelligence is the focus these days. And The Fabric focuses on cloud and networking infrastructure software companies. And then I also co-founded a smaller venture fund, early-stage venture fund in India. So I've been active in investing in India for over a decade. So that's my introduction, but happy to answer any questions that you may have.
Well, let's double-click down on March, since that's your primary activity currently. What
Sure.
are you investing in? What is the investment thesis of March Capital?
So March Capital has a pretty broad mandate. We don't have any sort of focus that our investors allow us to invest in stuff that we think is exciting for us in the next 5 to 10 year time frame. So if you look at our portfolio, you'll see a mix of early stage, which is Series A kind of companies, maybe 15 to 20 companies in every fund, that we will invest anywhere from $5 to $10 million in. And these companies, broadly today, 80% of them will have a focus on the enterprise, so enterprise software. And the majority of them, a vast majority of them, are data-driven companies. So the real way to think about it is, can you use these new data-driven technologies to create a competitive differentiation in the market and have a winning differentiation? And if you do that, really today gives you a leg up from legacy software, legacy cloud software too. So if you think about it, in the last 10 years, the enterprise software companies that have grown more than, I would say, the mean or the median are the ones that are using the cloud as a delivery platform. And we believe that in the next 10 years, companies that are using AI-driven technologies, whether it's machine learning, deep learning, or data-driven technologies, will have the same kind of growth on top of the cloud companies. So you'll see a vast majority of our companies have that in a flavor of that. Now, apply that into verticals. You can see that in cybersecurity. You can see that in customer care. You can see that in enterprise employee management, IT support. You can see that in ERP systems or the next version of, any process within an enterprise is being now redone with these technologies. So we have quite a few companies around there. Then we have a little bit of a growth focus in our fund. So we have companies that, are raising anywhere from $50 to $250, $300 million, or we can write anywhere from $20 to $50 million into a company. And so we have, a dozen such companies in our portfolio. Again, similar spaces, but more mature companies that are generating hundreds of millions of dollars of revenue kind of companies. And we have companies in India, a few companies in India, and then a few consumer companies that, I'd say less than 20% of our portfolio is consumer, but we do have some exposure to consumer companies.
So I was actually just about to ask you about geography. You said you have companies in India, so does that mean that you invest globally, you invest in North America and India, or what's the geographical coverage?
We don't, we will never say that we won't do something, but if you look at what we've done, majority of our investments, 75% of our investments are in North America, and about 25% global, and out of that 25%, most of that is in India. And the reason is what we do, we need local presence for. We have a partner in India. We have someone on the ground there. So we have someone on the ground to manage our investments. We have a small presence in Brazil. We're trying to see if we can expand that. That may become more important 5 to 10 years from now, but that's a growth place for us. We have a few companies from, one from Israel, one from Germany, from Berlin. But these companies generally are maybe headquartered there, but the interest for us to invest in them is they want to build their business in North America, and we become their conduits to do that. So
in North America, do you have any geographical preference, or are you investing all over North America?
We have, as you would see in most every fund, North America also has these little now ecosystems outside of the Bay Area being the biggest, where there are, there's a lot of innovation going on. So that sort of is represented in our portfolio too. We have companies in New York, we have a company in Boston, we have a company in Austin, a few companies in Austin. But most of our companies will still be California, I'd say. A good 2/3 will be California, Southern and Northern California.
Okay. And in terms of stage, you said your early stage work begins at the Series A level with did I read it right, that it's a minimum $5 million check?
It's not a minimum, but I'd say average is $5 million. We've written smaller, $1, $2 million checks as well. But if you have a fund size, let's say it's between $300 and $400 million, you need to have a specific type of investment. Smaller seed investments don't necessarily fit there. So for the seed stuff, I use our platforms at the Hive and Fabric to do more of that. They write the less than, from $0 to $2 million kind of goes in from the Hive and Fabric, and then as those companies graduate, March looks at them.
So, but on Hive, at least what I understand through my conversations with Ravi, and Ravi has been on the show as well, he is trying to do kind of bootstrap to exit with very small amounts of capital infusion. He's actually trying to drive his companies, his portfolio companies to an early exit, not necessarily working as a feeder into the venture ecosystem. Is that a correct observation?
No, if that is what he's saying, and I'll have to correct him. But I think that can happen, and it has happened. And it's been very lucrative for a small pool of capital like the Hive, where you have an early exit and you don't have a massive amount of capital on top of that. And the structure lends itself to that very well. So he's not wrong, as in that is one part of the strategy of the Hive, and it has worked very well for us. But having said that, a majority of the companies that have come out of both the Hive and Fabric have gone out and raised venture money after the Hive. So, I'd say out of the 25 companies we've had come out of the hive, maybe 3 or 4 have been sold, but a good dozen to 15 have raised venture money.
Okay. All right. So now I understand when you are working with hive companies as feeding into your venture fund, when you're working with more the general market of people approaching you, what are you looking for in terms of validation when you want to invest in a company? What do you want, like we've heard all kinds of metrics, all kinds of, conditions from various VCs who are looking at maybe a 1 million ARR, or what is your comfort zone?
Yeah, so I'm not sure we have any strict number-driven comfort zone. I think what you're looking for is some validation, whether that validation comes from the quality of the team and their past experiences, whether that validation comes from customers and numbers-driven validation, or it comes from footprint-driven validation, because we've seen companies that could have hundreds of people using them, hundreds of customers, but still hasn't quite turned on the revenue engine behind it. So there are, I would say, many ways for a company to be compelling. There's no one specific formula. I will say, though, the nomenclature of what used to be Series A looks more like seed now. What used to be Series B looks more like Series A now. So we are seeing more and more companies with more proof points behind them come to us even for a Series A. And, the Series A amounts have also changed. A Series A could look like $12 to $20 million into a company, which used to be 10 years ago a Series B. So I think those nomenclatures have necessarily changed. Yeah.
There's a lot of bootstrapping going on, and that I think is a very healthy trend, actually, because, you can get to more validation. The more validation you get, you're raising venture capital with more security and more understanding that you have a venture scale company. Very often, if you raise a lot of money in the early stages without understanding that, you may very well basically put yourself out of business by raising venture capital, because then you're not fulfilling the metrics and the expectations of your investors, and they're not going to continue to fund you.
So there are many things that go into that, but one of the things to sort of understand is we did some analysis a few weeks ago for our own investor base and our annual meeting, and you see that the average age of a company that's going public right now is about 11 years old. And 10 years ago, that used to be 5 to 6 years old. The average IPO is also 3 to 5 times larger than it used to be 5 to 6 years or 10 years ago. So as a fund that has a limited lifetime, you want to be closer to the seeing an exit in the 6 to 7 year time frame than 10 to 11 years. So all of that is shifted. It is also created for the C400. Maybe at the height there were 500 angel type funds that were under $50 million, maybe but under maybe $100 million. That number has come down a little bit. It's probably half of what it used to be, but it's still a very active part of the ecosystem. And so,
do you when you encounter situations where a company has already been around for a bit and it has taken them time to find their product market fit, but they have found product market fit, but there has been some amount of micro VC money that has gone into angel, or micro VC money that has gone into the company, do you sometimes buy these funds out?
Yeah, sometimes you clean out the cap table as best you can for the future. Again, it's all situation dependent. I can give you examples of companies where they've raised no venture money but have continued to raise money from strategics, which is another now source of capital, which probably 10 years ago was 1/10 of what it is now.
Yeah.
Big corporates now have very active investing programs. Take your pick. Any corporate will say that they have some kind of corporate venture program.
Yeah.
There are certain things a venture fund looks for in a company, structurally, team-wise, cap table-wise, process-wise, which are not necessarily best done in a bootstrap fashion or when you take money from non-venture resources. So there is a little bit of a I would say, clean up, catch up that needs to be done for a company to fit a venture profile in that case?
Well, I think I was commenting on your 10, 11-year, not just 10, 11 years. Some companies are going 15, 20 years and then finding exits, like lynda.com had a unicorn exit, but they were around for 20 years almost, I think 17 years or something like that. So, we have a company in our portfolio that is also something like 15 years that just completely bootstrapped, actually, no financing, and that's just sold for $60 million. So I think there's a lot of that going on at the moment, and I'm just trying to understand how you view it from a timeline point of view, from a larger venture fund, slightly larger venture fund point of view. So let's switch to your portfolio. Talk about a bit of some examples of companies that are representative and that you like a lot, and help us think through when they came to you and what did you see in them that really captured your imagination to want to write a check?
So I think that's a very broad question because we have all types of companies in different stages. So I'll give you an understanding of one
early
stage
company. Let's focus on companies that you were in right from the early stages.
Okay, I'll give you one that was a good exit for us where we sold a company to VMware for about $600 million called Velo Cloud. That started in the Fabric 5 years ago. And it was really an idea that the Fabric founders had around the fact that the cloud is becoming more and more compute and networking intensive, where you can take core networking functionality and deliver it from the cloud. That was a kind of a radical idea at the time because most people thought of the cloud as application focused, not as infrastructure focused. And so we started building this company, getting validation, meeting customers, but coincidentally met with two people who were a perfect fit as co-founders for this company. So Sanjay Uppal and Ajit Maiya were the two who joined us day zero. And basically, at the minute they joined the company, that company became real for us. And that became valid for a Series A investment. So these guys had done it before. They came from the industry. Both had worked together. They had gone to college together. They were a good team. And, they drove that company from zero to, I think when we sold it, they were close to $100 million of bookings in the 5th year of existence, which is in size and scale, in 5 years, very hard to do. Very few companies have done it.
Absolutely. That's venture scale growth. That's very hard to do.
Yeah. And so you look for that. You look for greenfield opportunities where you have, the compelling part of that was you have billions of dollars being spent when you have, when you open a branch office, say for a bank or a retail organization. The first thing you do is you buy a router, you hire someone to go configure that router so you can access the applications in your data center. And now what's happening is those applications are moving to the cloud. Your networking you don't need a T1 line. You can get a 1/10 the price a DSL line or a cable line and get the same kind of bandwidth. So you kind of had these multiple things happening at the same time that rise to a new way to deliver the same value. And, I think maybe we sold too early, but it was a great exit for us.
So this is more of a, trend question based on what you've just described, the story. The fact that so much is happening on the cloud right now, what do you see as the future of companies, the core networking companies like Cisco and Juniper? How do you see them evolving, and what are the opportunities and gaps opening up because of this shift?
So you can see that in their own strategies as well. They are buying software companies at multiples that could defy logic because they also see that their core business is completely threatened.
Yeah.
Look, big telecom companies still run on big iron. It's not like that's going away. It is fast becoming commoditized and value is moving into the software layer. And so, you have people like Amazon entering the data center now. They're no longer just a cloud company. That's a huge threat to companies like Cisco or others that are in the data center, or HP or Oracle, or take your pick. So it's not going away today or tomorrow, but the long-term trend is that big iron is getting commoditized. and all of the intelligence, all of the value is moving into the software layer. And so what that does also is opens up the field, because a startup to build a big iron box used to take you a couple of $100 million. But today you can actually build a similar value company, show the value in less than 1/10 that money.
Yeah.
So, there is a very healthy ecosystem now of companies competing with, and of course for us, we have probably 6 companies, 7 companies in our portfolio that ride on this trend, going right at the core of the networking business.
Can you talk a bit more about, since we are on this topic, can you talk a bit more about, what kind of problems are they solving in this portfolio that you just talked about?
So very simple problems like, you have now, if you have the Internet of Things and connected devices, and you suddenly, instead of having 5 billion endpoints, endpoints being your cell phones or your computers or whatever you are, you take that up to 30 billion, because now your electric meters are connected to the Internet, and your house is connected, your car is connected, and everything gets connected. The network that was built by people like AT&T and others, which was on big monolithic centralized devices, cannot keep up with it. It's not. It's too rigid. It needs to be more flexible. It needs to have more capacity at the edge, not at the center. And so a lot of that is driving for ways for new companies to innovate and kind of give that value. So we have a company in our portfolio called IoTM, which is using a cloud orchestrator. If I'm getting too technical, let me know. But think about this.
Perfectly fine.
They're saying, hey, if I have to now manage 1 billion devices, I cannot manage those devices by saying, if I want to upgrade something, I have to send someone on a motorcycle and put a computer and plug it into your building automation system and upload something or download data. You have to do it remotely. You have to do it securely. You have to do it in a scalable fashion where every device doesn't add another, workload to us. So you're building these agentless orchestrators in.
Can you hear Sumant? We can't hear you, Sumant. Okay, so he knows that we can't hear him. All right. Well, while we wait for Sumant to come back on, folks, please feel free to use the public chat to dialogue here. I see that Basant Valeti is introducing himself. By all means, all of you are welcome to introduce yourselves while Sumant gets back on the call. Basant says, Kulfi is a short-form entertainment, short clips and GIFs platform. We are building Kulfi to connect users with the content in the language they speak. Basant, be very careful about monetization models around stuff like this. It's very difficult to monetize media, and if advertising is your primary monetization model, that is very difficult to bootstrap. So have to keep all that in mind as you navigate.
So sorry about that. I think yes, I am. I think there was some network error or something.
Okay, so you were saying, go on. You were talking about one of your portfolio companies and the connected device issue.
Yes, and so think about their first application was building automation. And if you think about building automation, the data that's coming out of that today in your HVAC system, your lighting system, etc., needs to be protected, needs to be differentiated from the data that's coming out of your data center or your servers or something like that. So creating for a secure fashion to connect these devices, manage them from the cloud in an automated way is sort of the way that they've gone about building their business. And that's one application. They're in manufacturing, they're in oil and gas, they're in transportation. There's a lot of that kind of work that is new, probably more important 10 years from now than it is today, but definitely very important to connect these devices. Otherwise, you can't use them.
Yeah,
we have another one called...
The immediate one is that all the carriers who are dealing with, their customers, the last mile customers, they still have to send technicians if there's a real problem, they still have to send technicians in, and that's a very cumbersome model, and we're all at the receiving end of that, and it's very frustrating. If something goes wrong, it's very frustrating. It's very expensive for them to manage this infrastructure.
And no one's ever happy. No one's ever happy.
That's right.
Okay. So that's why this cloud is a good enabler for that.
So I know based on your fund size, you're probably still looking for more of the unicorn-style companies. Is that a correct observation, or am I missing something?
Yeah, I think any company that enters our portfolio needs to have the potential to be meaningful to us. So by that very nature, if you want one company to return you $100 to $200 million, it has to be valued at at least north of $500 million, if not $1 billion, at exit.
So if you look at the last 12 to 18 months of your deal flow, what are the trends that you see in that deal flow that have that kind of potential? What problems, what types of companies are you seeing that are venture scale segments or venture scale problems?
Actually, like I mentioned, most of enterprise software, where you think about the massive tens of billions of dollars of equity value that have been created in the last 10 years, is being reimagined with AI. So we think that area has that potential. So whether you take ServiceNow, which is a IT support company that has gone from, I think when it went public, it was probably $1 billion or $2 billion. Now is a $40 billion company. In the last 10 years, it's gone up that much. That IT service desk is being completely transformed using AI. And we have now a couple of companies going after that. Think about the call center industry, which is $350 billion spent every year. And like you mentioned, you call your Verizon or AT&T.
I think we have another technical problem. This is going to be very hard to transform into a podcast, Maureen. Sumant, are you back? No. Folks, we'll switch very shortly to the entrepreneur pitch section of the conversation. We're almost done here with Sumant. I'll just take a moment to wrap up. And while Sumant is getting himself organized, let me also start setting expectations for the entrepreneur pitch session. To all the presenters who will be presenting here today or later, I'm sure some of you are here thinking about presenting later, I just want you to know that this is a working session. It's a safe working session. You don't need to be nervous or defensive. We are on your side, so we'll work on your problems and we'll try to help you accelerate your journey, and that's about it. You don't need to be defensive at all. Sumant, are you back on?
I am, and I apologize. I don't know why. I think I was talking about AT&T and they cut me off.
Okay. Okay. So you were talking about the problem, the AIification, let's say, of the whole enterprise, and all the SaaS companies are going after their AI strategies right now.
So there you have potential of building unicorns, because there's hundreds of billions of equity value that's completely being threatened by these new technologies. You look at India, I think there are 14 companies in India that are worth over $1 billion today that are venture funded. My estimate is that number is 3 to 5 times that in the next 5 years. And so you have potential of investing in companies there that could be unicorns. We'll go into that. We have a couple in our portfolio already. Then you look at the industrial space. Now, think about, a nation's GDP, 25 to 50% of the country's GDP is industrials, and they still have not entered the internet age. That's coming at a very massive, very fast pace. In fact, I think this year and next year is when you'll see hundreds of millions of dollars of revenue coming in from these companies. So we have a smattering of companies there. So, you can take various different places and see how big these markets are, the revenue potential are, and then you can have a point of view on whether you can actually build a company of size and scale that matters.
Yeah.
That's how we think of it.
All right. Well, Sumant, thank you very much for your perspective here, and I'm sure we'll have a chance to connect afterwards.
Yeah, thank you.
Thanks for coming.
Yeah,
Audience, going to switch to the presentations now of the entrepreneurs. Remember one thing, if you disagree with my feedback today, that's okay, no problem. It's your venture. You're going to do what you want to do, what you decide that is the right thing for you. All I can do here is give you perspective based on experience and based on, most importantly, pattern matching. I have seen a lot, and that's what I'm going to give you perspective on the basis of. So just consider the feedback and then decide what makes sense for you. Remember one thing though, not all businesses can raise money, not all businesses should raise money, and raising money doesn't guarantee success. So here we go. We are going to actually not start with Maricielo. He has an emergency. We are going to start with we're going to start with Tim Lieu from the Villaging Company. Tim, please unmute your line and tell us what you're working on.
Great, thanks, Sumant. Hi, everybody. This is Tim Lieu here. So you can see over here, I'm working on this project here right now. So I'll just go ahead and get started. So again, my name is Tim Lieu.
Where are you dialing from, Tim?
Oh, I'm dialing from San Leandro.
Okay. Okay.
So yeah, I'm the creator of the viewers. So with us on the previous slide. So we want to change the world by inspiring personal growth, one word game at a time. And how we're going to do that? By answering just one simple question. How happy are you? So do any of these pictures resonate? Well, going too fast. Can we go back to the prior screen?
Yes, sure. Sorry. Yeah.
No problem. So do any of these pictures resonate? You're not alone if you say yes, because people are less happy now. Why? The general reason is too many expectations. And the solution is happiness must come from within. Next. So our solution is just a fun game that is more than a game. Vworks is a game platform for individual empowerment, and we believe empowered people are happier people. Let me share a bit about myself. This is my second startup. The first one was a fiasco. I spent 6 years and over 200K on it. I lost my day job of 10 years last June, so it was tough. But luckily, the vWork concept came around the same time, and it became the inspiration that gave me empowerment. There's a quote, all big changes of the world come from words, and I believe vWorks will inspire and empower many people in the future. It's free to play, solve 3-word puzzles, and compete for cash prizes based on ranking. Next. Content is king, and we take pride to make ours meaningful for each game. These specific categories are used because we believe there's a natural process for people to be inspired. We use lesser known places to open up people's mind. We want them to feel good about themselves, and we use quotes to turn on that light bulb for them. This trio will not only get the mind thinking, but also provide a boost of energy every time the game is played. Next. So vWork is more than a game. vWork is interactive, so learning can be fun and personal growth can happen naturally. There are Google links to the daily answers, and we want to create a chat community where life experiences are shared and learned from each other. Next. So here are some feedbacks from our players. We are heading in the right direction because they use words like motivate, learn, and fun. Our feel good category, which is the third one right there, also got some love. Next. So we have many competitors. because Reword is a multi-dimensional game platform, which makes us hard to copy because we are all of the above. Next.
So, Tim, we are quite far into your presentation. I still don't understand what this game does. Can you elaborate?
Yeah, so basically it's a word game. It's a word game, so it's kind of like a Wheel of Fortune type of game, right? I mean, you just guess the word. So right now it has a cash prize. It's a super tiny, it's a small cash pot. But basically you just solve 3-word puzzles. And then after that, then you're going to go to, earlier we talked about that, there's a Google link, so you can link it out to Google, learn about these different places. You can learn about the author of the quote, who said the quote. And then also there's a chat platform where you could share life experiences, right? So think about it. It's got to be like a Wheel of Fortune plus like a TripAdvisor plus a Discord, if you will. Does that make sense?
Yeah, but
Right.
I think it's, calling it a TripAdvisor is a bit too much of a stretch for me. I don't think you're pitching this right. If you're saying all of V-words is all of the above, that is a gigantic stretch you're making. So I think from what I see, your positioning needs work on what exactly is it. And, at some level, it doesn't matter if your game is getting traction and you're able to monetize. But if you have to convince, people who are trying to understand the business, I think you need a lot of work on the positioning. That doesn't work.
Okay, yeah. I definitely welcome any feedback. So that'd be great if you could help me out there. So revenue models. So these are how we gotta make money. Game sponsorship. So a second here. So Reword is a brand that promotes individual empowerment, and we think that's a positive association for companies who want to sponsor our game and advertise with us. We talk about this affiliate marketing where it links it out to places, so we could link it out to like hotels.com, Expedia.com, etc. Subscription has not been built yet, and it's going to be for like no ads, 5 points, and among other things. Next. So we just started. We're just scratching the surface, and we're seeking $1 million in seed funding to convert viewers from a game app to a game platform. Thank you.
I don't think this is a fundable situation, Tim.
Okay. Can you share more?
Gaming companies don't get funded unless your game has a lot of traction. And that's just the bottom line of it. Nobody is going to give you money to try to build and market an unproven game. That's just not the way gaming works. The gaming industry works from a funding point of view. So you're going to have to bootstrap your way to something that can produce exhibit traction. And I would advise you, because you have no choice but to bootstrap the early stages, figure out how to monetize what you're doing as soon as possible. So don't try to go for a free thing that is, going to be years of free until, you accumulate lots of users. Don't go for that. Try to come up with a model such that you monetize as you go along and grow, but grow with revenue. That is my whole advice.
Got it.
Okay?
Okay.
All right. Okay, folks, you're very welcome. We're going to have a little bit of a short roundtable today. I have to be at a meeting, so just very quickly, if you like what we're doing here, refer other serious entrepreneurs into 1Mby1M. And all our resources are at the website 1Mby1M.com. There's a terrific blog. You can start with the Entrepreneur Journeys book series that are case study-based books and on specific topics. These roundtables happen every week. You're welcome to come back to as many as you like, or also use the recordings. Our full acceleration program is 1Mby1M Premium, where we give you full acceleration full guidance, methodology guidance, and step-by-step project guidance. The self-assessment on the website is something we recommend you take a look at and apply it to your venture to see how you're doing on these various strategic issues. If you get stuck on methodology points, 1M Basic is a very good way to plug your methodology gaps. That's our curriculum-only option. And everything, all this is on the website. So dig around on the website and see if any of this is for you. Whether it's basic or premium or any other part of 1 million by 1 million, you are very welcome to use the program as you feel is appropriate for your particular situation, your particular learning needs. There are lots of FAQs, video FAQs, description of the curriculum. We operate on a case study-based model. So we have case studies of over 1,000 successful entrepreneurs, and that's what really we build this on top of. The methodology is bootstrap first, raise money later, not because that's necessarily what we want. It is because that's how the industry operates. You will not succeed in raising money as a first-time entrepreneur if you don't bootstrap to some degree of validation. So that's it. We have upcoming free roundtables pretty much every week from now until the end of April. Actually, now until almost the end of March, we have free roundtables. And then we have in-person rendezvous that are held at Cafe Boroni in Menlo Park in Silicon Valley. If you're local or would like to come in, you're coming in from somewhere else and would like to network, please stop by to any of our roundtables. Today is one, and then we have April 3rd and April 17th. And then we are open for Q&A right now. So Nimesh, Chiara, you're sending me private messages asking, do you present today? I believe you've already presented several times at the roundtables. I think one in some live session and one in one of these roundtables here, online roundtables. We do not allow people to pitch at free roundtables more than once. We've already exhausted your one time. You can ask questions if you like, but I don't think you can pitch anymore. If you want to be in the program, you're going to have to go join the program at this point. I'm happy to answer any other questions that you might have before we adjourn. If you have questions about the program, by the way, please contact Irina Patterson. Her email is irina@1mby1m.com. And that's pretty much it in terms of programming for today. Nimish, you're sending me private messages saying that you have not presented, but I believe, according to Maureen, you have presented. So you're going to need to resolve that with Maureen Kelly. I'm not going to get involved. Anybody else? Any other questions? All right. Folks, we're going to adjourn today. As I said, I have to be somewhere. So talk to you soon in the next session.